Yeah, the session has started.
Let the participants join. We will wait for 1 minute, 1 or 2 minutes. Happy evening to all of you. Welcome to today's meeting on Ind AS 113 and 116, fair value measurement and leases. Accounting standards 113 and 116 are two crucial standards that are designed to ensure accurate and consistent financial reporting. Learning these accounting standards is essential for necessary compliance, accuracy, transparency, consistency, and improved decision making. Today, CAP Sankaraman sir has joined with us today to take us through these accounting standards. On behalf of SIRC of ICAI, we welcome you, sir.
Thank you.
We will start today's program with the invocation of ICAI Motors.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामंशो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता
Thank you. Without much delay, I hand over the screen space to CAP Sankaraman sir with a small introduction about him. Sankaraman is a qualified chartered accountant with about 28 years of post-qualification experience. He has extensive experience of leading and coordinating large national and multinational audit engagements. His area of specialization includes audit in financial service sector, manufacturing, power retail and distribution, and a consumer business. His experiences also include managing a couple of initial public offering, performing financial due diligences, and internal audits. He has hands-on experience in IGAP, Ind AS, IFRS, and US GAAP. He has done audits under auditing standards generally applicable in India, international auditing standards, US GAAP, and public company accounting oversight board standards as well. With this brief, I welcome Sankaraman sir to handle today's session. Over to you, sir.
Okay, thank you very much, sir, for your kind introduction, and good evening, participants. Nice meeting you virtually today to discuss, as Sir Rahman said, two important topics on Ind AS, which would be Ind AS 113 on fair value measurements and Ind AS 116 on leases. Before I get into the session, I'm sure that you are able to see me properly, hear me properly, and able to see my screens moving. Rahman sir, if you can confirm, I can start with my session. Okay, hopefully it's working. So we'll start the discussion by discussing something on Ind AS 113. So what we will cover this evening would be to introduce the topic. We will discuss when the standard is applicable and what are the exemptions to the standard. As the topic suggests, it is fair value. So we'll understand the definition of fair value. We will understand certain key terms and concepts. We will understand how the evaluation needs to be done. We will also understand the disclosure requirements as laid down in the standard. Ind AS 113 defines what is the fair value. See, when you see Ind AS, one of the basic differences between IGAP and Ind AS is the applicability of the fair value concept. Under IGAP, we were used to historical cost or costs which were determined so long ago. But when it comes to Ind AS, across many standards, we would have come across stating that this needs to be fair valued. So there is one standard, which is 113, which we need to refer wherever other Ind AS say that the fair valuation needs to be done. So that is why we call it as a companion standard. It is something like AS-21. If we need to do consolidated financial statements, we refer to AS-21 to understand what would be the principles of consolidation that we need to use. So AS-21 will say, okay, do line by line, eliminate intercompany transactions, take care of the consistency in accounting policies. So it would guide you the manner in which consolidation needs to be done. Similarly, 113 would be the standard which will guide you how to fair value an asset, how to fair value a liability, or how to fair value entities' own equity, or how to disclose a fair value. So a fair valuation, as we know under Ind AS, can be done either at the time of initial adoption of the standard or the transaction, as well as the subsequent measurement. So any standard which deals with fair valuation requirement, you will end up in 113 to understand how the fair valuation needs to be done. So these are some of the examples. If you say 103, which is business combinations, it would say we need to fair value the non-controlling interest, or we need to fair value the assets and liabilities taken over. Or if you already had 40% and if you are increasing the stake to 60%, you need to fair value the 40% stake already done, because 40% is really a significant influence and 60% becomes control. And so the business combination standards kick in. If you say 105, it will talk about fair valuation of those non-current assets or group which are going to be sold. If we say in day 16 or 38, you either have the cost model or the revaluation or the fair value model. 32 will talk about compound financial instruments. 36 will talk about fair value less cost of disposals when it comes to recoverable amount. So these are some of the examples as laid down in the other standards, which says a fair valuation needs to be done. And I started my discussion by stating that you will jump into 113 and understand the principles on how the fair valuation needs to be done for these cases. So these are the examples where fair valuation would be required. So there are also certain standards where it would say there would be a fair valuation, but we need not go into 113, say 102. Share-based payments, it lays down the principle on how the valuation of the grants and options needs to be done. If it is going to be Ind AS 116 leases, it is outside scope. Similarly, if you talk about AS2 inventories, it is a fair value, but not a fair value, because taking inventory at cost or net realizable value, whichever is lower, is guided by the principles given in AS2, and we need not come into 113. Similarly, certain disclosures which are laid down by other standards, we go with the principles in that standard, and we don't need to come back to 113. Ind AS 19, employee benefits disclosures, or Ind AS 36, to disclose about the recoverable value less cost of disposals. So here the disclosure requirements are laid down by the respective standards, and so we need not come back to 113. So the 113 is a companion standard. It gives you the principles. We saw many examples on when you will come to 113 if we need to do the fair valuation. We also see certain exemptions on when we don't need to come back to 113, but look at the principles in the respective standards to do the fair valuation. So what is fair value? A fair value is a measurement for a particular asset or a particular liability, or it can also include entities' own equity. This is to see how much the market participant is willing to pay for an asset or to settle the liability. So this fair value is a market-based measurement and not an entity-specific one. So that's why we use the word market participant. Some of the characteristics of fair value is that it is done on an independent basis, meaning the transaction is not done between related parties. It is a knowledgeable basis, meaning whoever is transacting in the asset or liability will have a reasonable understanding of the nature of the asset or the liability. And the third aspect is that you have the ability and the willingness to enter into a transaction. It is just not by force that you are compelled to enter into a transaction. So what is fair value? Again, if we go slightly into detail, it would be nothing but the consideration you will get for selling an asset or which is paid to transfer a liability. Again, the important term is that what is considered by the market participant who will act in the best economic interest. So it has to be an orderly transaction. As I said, it has to be done by motivation and not by force. So it should not be forced sale or a distressed sale. The computation is done on a particular date, which is called the measurement date. That is the date on which the transaction takes place. And it will be under current market conditions, meaning it would be a kind of exit price. So there can be two prices. One, the price at which you enter into transaction, and one, the price at which you will exit a transaction. So this fair value is a price at which you will exit a transaction. Take an example. If company A wants to enter into an interest rate swap with bank B. So here the market condition would be, if it is going to be A, since he is only a corporate, he can consider it as a retail market. But for B, he could consider it as an interbank market. But we need to consider the market participants in case of this valuation of IRS. So what again the standard talks about is taking into account certain characteristics of the asset or the liability if the market participants would consider those characteristics when pricing the asset or a liability. See, for example, if you consider an asset, the condition of the asset, the location of the asset, whether there are any restriction in sale or use of the assets, these would be certain conditions or characteristics which are important. So whether to consider these characteristics or not is also given in the standard. So if the market participants will consider the characteristics in pricing the asset or a liability, then the standard says these characteristics should be considered. Take a case of a loan receivable. Okay, if there is a loan receivable, then the credit rating is very important because the credit rating will determine his ability to pay. So if the market participant considers the credit rating in fixing up the interest, generally they do. See, that's why anybody who borrows will say that my debt instruments, be it working capital or a commercial paper or a NCD, is rated by CRISIL or ICRA, because higher the valuation or the rating given by these agencies, the better interest rate you can get in the market. So the market participant in these cases considers the credit rating as one of the characteristics in determining the price. So if the market practice is that it is considered, then when doing the fair value, you need to consider the credit rating. So this is how the link between the characteristics of the asset and the liability, whether it needs to be considered or not, is determined. And the specific aspect we need to look into it is whether those factors would be considered by the market participant or not. Okay, so now having considered the characteristic, the next question is, what is the unit of account? Say we are all comfortable with unit of account. If we account for inventory purchases, we say it is a bale of cotton or a ton of steel, etc. So the bale or a ton becomes the unit of measurement. So when you do the fair valuation, what should be the unit of measurement that you use? Again, we started the discussion by stating that the fair valuation would be guided by the respective standards. So depending on the standard which requires the fair valuation, the unit of measurement is also considered. For example, if it is going to be a derivative instrument which is valued as per Ind AS 109, so you consider the particular contract as the unit of measurement. We all know that if you are going to evaluate an asset for goodwill or an asset for impairment, we consider the cash generating unit. If you are going to fair value the 12% equity stake in a say company called Infosys, then the market price of Infosys share on the date of valuation will be considered as the unit of measurement. Again, for impairment analysis, we understood that generally it will be the CGU. So, depending on the standard which requires the fair valuation, you determine the unit of measurement or unit of account which you need to consider to do the fair valuation. Okay, so we saw the definition, we saw who is a market participant, we saw the unit of measurement, we saw the characteristics which needs to be considered or not. So based on these factors, how do you determine the value? So the pricing will depend on what the market participant considers. You consider the principal market. So what is the principal market? Is that it is the market in which it has the greatest volume or the level of activity. See, this we would have even come across when we did high gap. Say, for example, if we need to do market value of equity shares, so the shares would be traded both in BSE and NSE. So generally, we take that particular market in which the volume was more or significant as on the valuation date. So here also the same principle is being adopted. So in that market which has the greatest volume or the level of activity will be considered as the principal market. Or you generally determine based on which market the person will go, or the person here I mean the market participant will go to sell the asset or transfer the liability. So that market would be considered as the principal market. So the principal market will be determined by the entity. You take into account all the information which is reasonably available to you. It is not that you are required to do a thesis or a very exhaustive study in terms of how you do it, but we need to take care of it in a reasonable manner so that you determine the principal market correctly. So if there is no principal market, then the standard says that we can take the most advantageous market, which means in case if it is going to be an asset, that market which will give more value for sale. If it is going to be in case of transfer of liability, that market which will reduce the value of the liability. So the principle is that you go to the principal market. If it is not going to be determined or available, you go and choose that particular market which is most beneficial. So there are 2 or 3 more terminologies that I have put in this slide. One is on transaction cost, one is on directly observable, and one is on valuation technique. So I will talk about those aspects in the coming slides, because this slide, the purpose is to determine the pricing, and the principle that we need to understand when it comes to pricing is that we need to consider the pricing in the principal market, and the principal market is nothing but the one where there is the greatest volume or the greatest level of activity. So now the first terminology that we saw in the previous slide is the transaction cost. So what is transaction cost? To do a transaction, we may incur certain costs. Say, for example, if you want to purchase inventories, there you may have to incur, say, transportation cost. So whether these costs, which forms part of the transaction, needs to be adjusted to the fair value or not, is the question that we are discussing here. So if the location is a characteristic of the asset, the price in the principal market shall be adjusted to the cost, if any, that would be incurred to transport the asset from its current location to that market. So again, we go into the same principle. So what is the principle? Whether the market participant will consider it as a characteristic. So if transportation cost is a specific characteristic which needs to be considered, then you consider it. If it is not going to be a character which is considered by a market participant, you need not consider it. So generally, cost of shipment would be considered. Generally, commission payable to agents on sale of real estate need not be considered, but it is just an example. But if you are in a market where any real estate transaction happens with a commission to an intermediary or a broker, then you may end up assuming that the transaction cost in terms of commission payable to agents should also be considered. So it is not an yes or no answer. We need to consider the characteristic of the market in which the transaction generally happens. So as I started the discussion, when I defined fair value, I spoke about it would be a price which will be received to sell an asset or pay to transfer a liability. We also discussed what would be the transaction price, which is nothing but the amount I will pay for an asset or assume a liability. So what is the difference? So generally, the same, if I'm ready to sell an asset at X rupees and you are ready to purchase the same asset at X rupees, the transaction price for you and the price at which I sell is more or less the same. But there could be some circumstances wherein there is a difference between these two. So the standard says that in case if there is difference between these two, then the difference should be adjusted to P&L on day number 1. So what are the circumstances in which these two day rates can be different? In case if the principal market that you consider is different, then the fair value of the transaction price can be different. But this is provided as the standard, but generally what we have seen in practical experience is that the fair value price and the transaction price is more or less the same. So the next topic which is being dealt with by the standard is valuation of a non-financial asset. So when it comes to non-financial asset, the concept that is being used is that the non-financial assets should be valued at the highest and the best possible use. So again, this will be determined from a market perspective or a market participant perspective. So generally you consider the use of the current asset on a standalone basis or in combination with the other assets and liabilities. So what does it mean? So you have an asset, you want to sell that asset. Okay, so an asset, say land, it is a non-financial asset. So how do I determine the value of this land when it comes to fair value? Because what we understood as a fair value is the price at which you will sell this asset in a market condition to a market participant. So the principle that is given is that you should consider the highest and best use. I'll just give you an example. So you may have a factory. So you had an industry. So that industry is no longer viable. So you have already dismantled the company and you have exited the business. You have land. So now you are in a position to dispose of this land. So how do I value this land, which is going to be a non-financial asset? So we have to consider the highest and best use. Say, for example, if that land is amidst an IT industrial park and there are many industrial parks in that area, and you know that if we construct an industrial park in that area, you will be able to gain a lot. So if there is some constructor who is going to come and say, give me this land, I will construct an IT park. So in this particular case, you may even consider the proposed use of this empty land if that proposed use would fetch a better value, because the concept that you are going to use here is the highest and best use. So if there is a market participant who wants to come and use this empty land in a particular manner, and if that particular manner would be the best possible use of that particular asset, then you can even consider that for the purpose of determining the fair value, and you don't need to consider the purpose for which you were using the land. You are using the land for a factory, but the best and possible use comes from using that land to build up an IT park. The standard says that you will be able to use that. So for this non-financial asset, when you do the fair valuation, there are 3 characteristics that you need to consider. One, the physical characteristics, that is where the land is there, what is the size of the property, any legal restrictions or use of the land or use of the asset. So in case if there are legal restrictions, see in my example, if it says that there cannot be any factory constructed in that particular area, then though you conclude that constructing a factory would be the best possible use, because of the legal restrictions, you cannot consider a factory because it could be environment polluting or it can have lots of waste discharge, etc. then we also need to consider the legal restrictions. The third aspect that you need to consider is that it should be financially feasible, meaning the non-financial asset should be able to generate adequate income or cash flows. So to value the non-financial asset, you consider the highest and the best use, and you also consider these three important characteristics, which is the physical characteristics, legal restrictions, and the financial feasibility. So this is from the asset side. So as I said at the beginning, the 113 standard is also relevant for valuing the liabilities and equity instruments. So for asset, what we discussed was how much you will get if you sell the asset. So when it comes to liability, it will be the ulta, meaning how much people are willing to pay to take this liability. So a fair value measurement assumes that the financial or a non-financial liability or entity's own equity, we need to assume it is fully transferred to a market participant and it is not a settlement. So what is the difference between transfer and settlement? Settlement is just taking and paying off that liability once for all. But what 113 says is that you should assume as if the liability would be taken over by the market participant and he will continue settling that liability and it is just not a one-off settlement. So that is why these two assumptions given in the standard is very relevant. A liability would remain outstanding and the market participant would be required to fulfill the obligation. So this is the premise based on which a liability will be valued. It is not done with the premise that the liability would be settled immediately or extinguished on the measurement date. Similarly, when it comes to entity's own equity, it would remain outstanding and the market participant will be taking the rights and responsibilities of the instrument. It is not that the instrument would get cancelled or extinguished. So it is more, if I have to put a very, what should I say, simple example, going concern. So you take the liability or an equity instrument and you continue with that liability and equity instrument and fulfill the obligation. It is not the value at which you will square off the liability or repurchase the equity instrument on that particular date. So this is the manner or the assumption in which you fair value the assets, the liabilities, and the equity instruments. So there are a couple of examples. Say, for example, A Limited has a note payable which is subscribed by B Limited. So A Limited has to fair value this note. So in books of A Limited, it will be a liability. But in books of B Limited, it will be an asset. So generally, valuing an asset could be possible and slightly easier than valuing the liability. So what we can do is, we can even consider the value of the asset as lying in the books of B Limited. And that can be considered as the fair value of the liability for A Limited because the contract should change. That's what I said that in the beginning, the exit price for one will be the entry price for the other. So the standard provides this manner. So in case if in this case, valuing the asset from a B Limited perspective is observable and you have data, then you can use that value to determine the value of the liability in books of A Limited. So there may be certain circumstances wherein you may not be able to do this principle because the asset would not be appearing in the other side's books. Say, for example, decommissioning liability under AS-113. So a decommissioning liability will not be appearing as an asset in anybody's book. So what is decommissioning liability is that this is the cost that you would probably incur after a period of time when you have to settle the asset back to the owner in the same manner in which you took over. So in this case, what should we do? We don't have any other option but to value this liability. So you consider the facts like what would be the labor cost, what would be the dismantling cost, when you should incur this cost, what would be the inflation, what would be the non-performing risk. So these would be certain assumptions that you would do to compute the liability. And if at all you transfer the business and somebody wants to take over this asset, including the decommissioning liability, then they need to take it with these assumptions and the valued liability, because again, last paragraph, what we discussed in the last slide was that the liability is going to be taken over and it is not just the person is going to settle the liability on that particular day. So these are a couple of examples in terms of how the fair valuation of the assets or the liability should be made, whether it can be made by doing the contra, that is the asset in other people's side, or if the asset is not available, how you will value the liability in your books by considering various assumptions. So till now I have been talking about valuation, etc. Now the standard also provides you certain techniques on how the valuation needs to be made. Again, the standard provides you multiple options. The standard does not say which one needs to be mandatorily used. So you can select the particular methodology which you feel would be most appropriate in the circumstances and for which sufficient data is available. But for that class of asset or a liability, you need to ensure that you apply the method of valuation consistently. So in case if there is a change in method, then you will apply the principles of Ind AS 8. So to do this method, you will have to choose something where there are maximized relevant observable inputs. So I will talk about what is an observable input and what is a non-observable input in my coming slide. So you select that methodology, you be consistent, and you select the methodology based on the characteristic of the asset or a liability. So what are certain methods that is available for valuing the liability or equity instrument? If there is a market, you can use the quoted price. If there is quoting is not available, you can use the price of a similar item which has been transacted in the market. So what is observable? It is nothing but the market data which is independent for which you have support. Say for example, I go back to my example of Infosys. I need to fair value the Infosys shares. I take the fair value from NSE. So it is an observable input because there is a market data which is available. So anybody in the world who fair values Infosys on 31st March, if they determine that NSE is their primary market, will take the market price from NSE. So forget that it is not Infosys. It is the shares of B Limited which is not quoted. So what should I do here? I will have to fair value the fair value B Limited and then determine the value of the asset. So in this particular case, you are doing certain own assumptions which is not in the market. So that is why you call it as a non-observable. So this distinction of whether it is an observable or a non-observable will be very important when it comes to valuation methodology. So I said the standard provides for multiple ways in which the valuation needs to be done. The three methods are, we know about it, we have dealt with it in whoever has done valuation, you all be familiar with this. It can be an income approach, it can be a market approach, or it can be a cost approach. So what is income approach? It would be basically the income that you will earn in future discounted into present value, which you will consider as the value of that particular asset. Meaning the future cash inflows, you are going to discount it and convert it into one particular value, and you will say that value is the value of this particular asset. Market approach, as I told you, it can be based on quoted, which can be observable or not observable. Cost, what would be the cost that you will incur to replace this particular asset? So current replacement cost. So we are familiar about these three methodologies of valuation, not directly with reference to Ind AS 113, but during our other application of a valuation technique as part of our jobs. So the same principles are being laid down in the standard and says this could be one of the three valuation techniques that you can use, determining the based on the characteristic of the asset or a liability, as I spoke just now. So what is income approach? Present value, option pricing is some of the models. It is nothing but discounting future cash values to net present value. So in one case, say investment property. So I have a property, I have given it on lease. I know my lease rentals. So the present value of the future lease rentals with some assumptions for terminal value was considered as the fair value of this particular property for the purpose of disclosures. So these are some of the techniques like option pricing or DCF for determining the value under income approach. So market approach, as I said, what will be the value that the market participant will be willing to pay you either to receive the asset or settle the liability. So multiples or maturity pricing or some of the approaches, or sometimes you can even get the quote from dealers or brokers. I can say, boss, I hold this notes in B Limited. So if this is the rating, what would be the rate at which you will try to take this value? So a broker quote or a dealer quote can also be an acceptable method by which a market valuation is done. Cost approach is current replacement cost, as I already discussed. So when I look at Ind AS 113, it does not prefer any particular method. It does not say one method is better than other. It only says that you choose the methodology of valuation technique which you feel would be the right fit for the asset or the liability or the equity which you are valuing. Again, the judgment call is given to the entity which does the valuation. So, having understood the valuation techniques, we also understand that for any valuation, there would be certain input data that you need to give. So, this input data can be different. So, there could be a market price, there could be DCF, there could be current replacement cost. So, this standard 113 also gives you something called a fair value hierarchy. So what is hierarchy in this standard? It defines the inputs or the parameters that you use for valuation at 3 levels: level 1, level 2, and level 3. So what is level 1? It is basically the quoted price in active market for identical assets or liability that the entity can access. So the simple example will be the NSE code. So anybody go to NSE, get the rate, do the valuation. So this is level 1 input because there is an active market for the asset or liability that you are dealing with. What is level 2? Level 2 inputs or inputs other than quoted price that are observable for the asset or liability either directly or indirectly. So you may not have a direct transaction, but you can get an indirect transaction or a similar transaction. And you can say, boss, a similar asset in this market has fetched this much value. The asset I hold or the liability I have in terms of characteristics is very similar to this transaction. So I can use this transaction as my benchmark in doing a valuation. It is not the same, but it is similar. Level 3, you don't have anything in the market. It is not observable. So you need to develop your own assumptions and the model for doing the valuation. So as we understand the 3 levels, depending on the example, we will be able to conclude which is the most preferable one. So that's why it says 1, 2, and 3, and the preference would be coming in that particular order. So the hierarchy would depend upon the inputs that is being given. So we spoke about in this part of the discussion, the valuation techniques, which can be income, market, or a cost approach. And then we spoke about, based on the inputs, there could be 3 levels of hierarchy to do the valuation: level 1, level 2, and level 3. So these are certain examples. So level 1, it is market based. You should have sufficient frequency and volume, say stock exchanges, or it can be future contracts where you will have exchanges being traded in contracts being traded in exchanges, or it can just be a broker quote. But generally, broker quote will not consider as a level 1 because we need to understand how the broker quote is being determined. What is level 2? Identical instruments. It can be in inactive market or similar instruments in active market, or it can be market related like interest rate or yield curve or LIBOR linked. Level 3, it is based on forecast or it is based on management coming out with their own valuation. Say, for example, if there is a patent or if there is an intangible. So if you don't have any level 1 or level 2, then the management would probably come with their own parameters on how the valuation needs to be done. So it is completely non-observable. So it falls under level 3. So this would be some of the examples what we have practically seen on which level you would fall into when it comes to the fair value hierarchy. So this is about the standard. I will just summarize it and then come to disclosures, and then probably spend 5 minutes to answer any of the queries that you have before I get into 116. So we started the discussion by understanding what is 113. We understood what is the fair value definition. We understood what is the market participant. We understood how an asset needs to be valued and how a liability or an equity instrument needs to get valued. We spoke about what is observable and what is not observable. We spoke about the fair value hierarchy in terms of level 1, 2, and 3. And we also spoke about the various methods that can be used to do the valuation, which is cost method or market approach or the income approach. So disclosures, you will probably disclose all these things in terms of how the valuation was done, what is the observable method, what is the highest and best use, what is the recurring value, what is the non-recurring values, and what are the items for which the fair valuation of made, why are you doing a fair valuation, if there is some asset which was done at level 2 in the previous year, but it has moved to level 2 in the current year, why the change has happened. If there is any change in the valuation technique, the reasons for why the changes has happened. If it is going to be L3, describe in very detailed mechanism the process that has been used to do the L3 hierarchy. And why are you doing the fair valuation? If it is going to be only for disclosure, you state that this valuation is done only for disclosure purposes. So this is the summary of the standard. Identify what is being fair valued. Identify the unit of account. Identify the principal or most advantageous market. Identify the market participants. Identify the characteristics that you need to consider. Identify the transaction cost, whether it needs to be considered or not considered. Select the approach. Select the hierarchy. Finalize the fair value. If it is going to be for measurement, take the entry based on this fair value. If it is going to be disclosure, make the disclosures based on this fair value. So this is a very quick summary of 113, and this slide summarizes what we have discussed in the last 40-45 minutes. So I can pause for a couple of minutes here. So in case if you have any questions or concerns or aspects that you want me to discuss in detail, I can do that. And then probably I will get into the next standard for today's evening discussion, which will be in AS-116. So I'll pause for a couple of minutes and see whether somebody has any thoughts on this. Somebody was asking whether the recorded version will be shared. I think you need to check this with SIRC in terms of A, whether it's getting recorded, and B, whether it will be shared. So SIRC can answer it. From my side, generally what I do is I share the PDF of the presentations to SIRC. And if SIRC has a practice of sharing the presentations to the participants, they will do it. So any other questions? It's a, as I said, this standard is more in terms of giving you the principles. So you may be able to appreciate the crux of the standard on how it works when you actually do and review evaluation. Otherwise, it will be probably too theoretical. I can understand that. So suddenly, if I say do level 2 income approach, we may not be able to appreciate what we are discussing. But once we get into it, once you start doing the valuation, you will be able to link back to what we have been discussing and what it can be done. Can you suggest which is the best method of valuation of investment in a partnership firm? See, again, the standard does not give which is the best method. So when you say investment in a partnership firm, I think you are a partner, say you hold 40% stake in a partnership firm, and you need to do this fair valuation in your standalone financials. So there is no one single method. You can go based on the income approach probably to know how much income you will get as a partner in the partnership firm, or you can even probably go with the net asset value of the partnership, like what we do for companies. We do the DCF, we get the valuation of the company, and if that valuation is the company for 100% stake, if you hold a 5% stake, you apply pro rata percentage. So something similar to unlisted companies, wherein we do the valuation of the company and then you value your stake. Something similar can be done for a partnership firm, because level 1 is ruled out because it won't get listed in any securities. So it should be level 2 or level 3. And I would prefer income approach would be a option, because again, there could not be much of market transactions wherein somebody transfers a stake in a partnership to somebody else. So not the right answer or the best answer, but looking at the logic, this could be some of the parameters that you can consider to do the valuation for your interest in a partnership firm. I'll wait for another couple of minutes. Generally, we don't get into value. The question here is, would it be okay to do a value averaging between income method and net asset method? See, my personal view is that generally we don't go with doing an average. You choose a methodology and you stick on to it. I have discussed this concept in various other aspects also. Say, for example, even when it comes to materiality, people will say, I will do the materiality in 3 different methods and do one value. So that's not the crux of how the valuation needs to be done or materiality needs to be considered. You apply a methodology based on these factors which are there in the standard, and then once you conclude that this is the right method, this is the right approach, these are the assumptions, these are the inputs observable, these are the inputs which are not observable, then my preference would be you stick on to that valuation rather than saying that I will do A, B, take whichever is lower, take an average. Generally, I don't prefer that kind of thing. Again, I'm not a valuation expert. So when it comes practically, you can talk to the people who does the valuation. But as an accountant, my preference would be you stick on to the method and do the valuation based on that, rather than combining the methods and taking an average. I'll just pause for 1 more minute. It's 5:48 now. At 5:50, probably we can start with 116. So 1 more round. Is the type of hierarchy based on the nature of inputs available for the selection valuation method? Yes, you are right. Level 1, level 2, level 3. So it depends on the observable inputs. As I said, a market price of Infosys available in NSE, directly observable, to take it as level 1. Because the reliability that you can have will be at a very high level. So the less observable the inputs are, the more assumptions you do into the valuation. I won't say it's reliable, not reliable, but the more assumptions it is, the judgment calls comes into play, and your judgment can be as good as my judgment, and that could be difference of views. So that's the logic based on which the hierarchy is defined. Okay, so that's all in AS-113. So if there are any further questions coming on 113, probably I will take it up along with 116 or after completing the 116 discussions. So let us move into 116 now. Hope the slides are visible and moving. So Yeah, very recent in days, which has been introduced. When I say recent, it's at least another 3 years old. So one of my favorite topics with SIRC, I've done quite a few sessions on leases under 116. So what we will be covering during this discussion, again, we will talk about the standard, we will talk about the classification, we will talk about the accounting, we will talk the accounting from both lessee perspective and lessor perspective. We will look at some specific transactions like sale and leaseback transaction or subleasing. We will look at transition provisions, and we will look at the disclosure requirements. Uh, when this standard got introduced, yes, it was slightly complicated, meaning we need to understand the principles that we were used to doing the accounting for leases in a particular manner, and this standard was trying to give you a completely different approach. So there were assumptions, there were judgment calls which needs to be taken. But now with this standard being in work for at least 3-4 years, we have become very experienced in adopting this standard and doing the accounting. So we will look at certain of these aspects with some live examples and then see how we need to go about accounting for 116. See, when we track the history of lease standards in the country, we had AS-19, which is the IGAP standard, which is still there. Then we had India AS-17, that was more or less equivalent to AS-19. And then came 116, which is significantly different from India AS-17. So this would be standard which is more relevant for an operating lease rather than the finance lease. So how did we account for operating lease? And again, this would be more relevant from a lessee perspective rather than the lessor perspective, because the changes that has been brought about by Ind AS 116 is significant from an operating lease lessee perspective. So that's the matrix that I would focus during the discussion, because from a lessor perspective or a finance lease perspective, there is not significant change as compared to either Ind AS 17 or AS-19. So how are we accounting for operating leases under AS-19 or Ind AS 17? So we would pay rent on a monthly basis. So we debited P&L with the rent. So in case if we had non-cancelable leases and if you are an non-SMC, the commitments relating to the non-cancelable period was disclosed as contingent liability in the notes. Okay. In case if you had step-up rent, meaning first year I pay 100, second year I pay 110, third year I pay 120, you are also straight lining the rental expenses and you are accounting for a deferred rent asset or a liability. But one of the biggest disadvantage in this particular method was two things. Why two? One, the model in which you operate could be different, meaning some companies would be having most of the assets as owned, or some companies would be having many of the assets taken on lease. Say, for example, take a car distributor. Distributor A can have most of its distribution in the own premises, whereas distributor B could do the business in rental premises. So when you look at the financial statements of these two companies, you could have significant changes when it comes to aspects like the asset ratio, the PBT, etc., because the model is different. The other aspect was when you enter into a lease agreement for long term, there is a commitment that you are entering into. And this commitment could give rise to various rights and obligations. These commitments would have a direct impact on the manner in which you do the business, or if I go even one step further, whether at all you will be able to continue doing the business or not. I'll take an example of a retail chain, say Shoppers Stop. Say they may have say 75 to 100 premises across country. Don't know the number, just guessing. So each one of this, as you know, the Shoppers Stop, it will be huge in terms of square feet. If this have been taken on operating lease, initially under AS Ind AS 17, you are just seeing the commitments and the lease expenses being debited to P&L. But these agreements could come with a right which is nothing but a right for you to use the property in doing the business. And it could also have lots of obligations. So this critical information in terms of the obligations are not known to the readers of the financial statements or the users of the financial statements. And this right, which is given to you, is a kind of intangible asset which is not finding a place in the balance sheet. So to balance these two things, to value the right and to make available to the readers the obligations, there was a significant change coming into Ind AS 116 with reference to the disclosure aspects and as well as the measurement aspects. So what has changed? How do you value this right? How do you account for it? How do you disclose it? Or certain aspects which we will be discussing. So the crux of the change is what was lying as an off-balance sheet item in terms of commitment of leases of the future period is now becoming an on-balance sheet item in terms of accounting for the right of use asset and the corresponding liability. So this is the single largest change that has happened in the standard. So this standard came with effect from 1st April 2019. So it talks about the control model. Again, as you know, many of the Ind ASs are now talking about the control model. Earlier it was risk and rewards, now it is control. The change happened on revenue recognition. The same happens in leases also. As I said, it is coming from a lessee perspective, operating leases, and try to bring the lessor accounting and the lessee accounting asymmetrical. Because under 17, what did we do? The lessee was accounting as lease rentals and the lessor was accounting as an asset and booking lease rental income. Now let us see how this accounting is becoming asymmetrical. There are lots of judgment which goes into the accounting of this standard, right from defining what is the lease, what is the discount rate that you need to lose, what is the portfolio applications, what are the transaction provisions. So there are significant assumptions which we need to use, and we will touch upon those assumptions and the concepts as we run through the standard. Just to give you an example, if you look at the first balance sheet of Indigo after the adoption of this standard, this is the value of the asset and this is the value of at which the liabilities and the assets have increased. See the impact it had on the size of the balance sheet. So what happens in this methodology is that from a P&L perspective, the costs are getting front-ended because I will say why of it. The ratios could get impacted like EBITDA. The cash flow presentation can get impacted because what was sitting as operating activity now can move into a financial activity. There is no change from a taxation perspective, which means you need to undo all these adjustments. And for taxation, it will just be the lease rentals, which will be claimed as an expenses. And there could be a deferred tax impact because the carrying value or the measurement value of the assets and liabilities from the book perspective and the taxation perspective is different. So this would be the probable areas on how the accounting under 116 could impact. So we will understand how each of these items is getting impacted. So we'll start the discussion by understanding what is a lease. A lease is a contract that conveys the right to control an identifiable asset for a period of time in exchange of a consideration. If I get into a rental agreement for 3 years for 10,000 square feet, so it gives a contract to me to use this premises for business for 10,000 square feet area for 3 years, which is probably the period of lease. Whether all these points as given in the definition is being met should be applied on the date or the time at which the contract was entered into. So when it says right to use, the entire economic benefit by using that asset, it can be profit, it can be cash flows, should be available to the lessee who has taken the asset on a lease. And you should be able to identify the asset. Say, for example, I do a departmental store. I have taken 1 lakh square feet of rent I can sell things in the departmental store. I earn profit on sales, and this profit is available to me as the owner of the departmental store. Then it comes into the definition of lease. So there are certain exemptions. So the biological assets under Ind AS 41, service construction agreements under Ind AS 115, license of intellectual properties under 115, right of lease under licensing agreement under AS-38. So each of these standards have given an exemption because those particular standards deals the manner in which these aspects needs to be dealt with. So for these aspects, you don't need to come into 116. So there are certain exemptions given in the standard. You need not apply the standard, the principles of the standard for all the leases. So what are those exemptions? Short-term leases and low-value leases. So what is a short-term lease? If the lease period is going to be for less than 12 months, then you can treat it as a short-term lease. And the period of lease is considered at the time of entering into the agreement. So if it is less than 12 months, you can say, boss, I won't apply the principles of Ind AS 116, but I will continue the same old method wherein I will just charge off the lease rentals to P&L on a monthly basis. If a lease contains a purchase option, then it will not be considered as a short-term lease. And whether the short-term lease exemption you need to take will depend upon the class of the underlying assets. So what is underlying asset? A class of underlying asset is a grouping of underlying assets of similar nature and use in an entity's operation. So the first exemption given to you is short-term leases. So the other exemption that is given to you is in case if you conclude that the asset that you have taken on lease is a low value lease, then again you can take the exemption. So what is low value lease? So if you take some assets which can be used independently and they are not interrelated or dependent on use of other assets. That's the first criteria. Two, it is not of a very high value when it is new. So when you satisfy these two qualitative parameters, then you can probably consider the asset as a low value asset. So the value of whether it is a low value or not can be done on a lease by lease basis. So the first lease you can consider as low value. The second lease you can say it is not a low value. The standard does not give you any threshold as what is low value. So the threshold can be determined by the company. So again, I'm saying there are two exemptions, short term and low value. Less than 12 months, it is short term. If the value is less when it is new and it is an individual asset and it is not highly dependent or interrelated to the other assets, you can say it is a low value asset. So in these two criteria, you can continue accounting the cost of lease as rental expense in the P&L and you do not apply the principles of the standard. The next concept that the standard deals with it is called a portfolio application. What does it mean is that you need not apply the standard for each and every asset, provided you are able to combine a class of agreements based on the nature of assets. So the question I have is how in case of computers, laptop can be taken as exempted asset for lease accounting. So you can probably apply the principles of low value. If a cost of computer is say 60,000 rupees, even if you buy 1,000 computers, based on the materiality that the entity has fixed, you can say it does not, it is a low value item based on the threshold that I have fixed. And you can continue amortizing the cost of rentals as P&L and you need not adopt Ind AS 116 for that. So coming back to portfolio application, it is a practical experience. So let me give you an example. Say, for example, I am in a, say, dairy industry. I need to procure milk from various farmers from across the state or and across various villages. So I need transportation. So I get into agreement or a contract with various transporters. So I may say, I need this truck, I need this daily, it needs to be air conditioned. This is the travel you need to make from this place to this place to get the milk from the collection places to my factory or chilling plants. So you get into say 100 such agreements for a quarter or a half year. So the characteristics of this agreement is more or less consistent because it will be the same criteria, more or less same value, etc. So in those cases, you will be able to apply a portfolio application, which means I will not do the accounting on each and every individual contract, but I will consider all these 100 contracts as together and then do the application. The point that you need to take care of here is that you need to substantiate stating that the value I get in the financials will not materially change if I do it on an individual basis as compared to doing it on a portfolio basis. So this is a practical expedient which is available to you, and you can choose this to determine whether a portfolio application would be possible in your particular case. So this is the next concept that we need to understand is what is substantive substitution right. So as I said, when I discussed the meaning of lease, I said you need to enjoy the benefits that you get from the leases. So I also gave you an example of say 10,000 square feet. So there could be two kinds of agreement that you can enter into. Say it can just say 10,000 square feet. So if it is a multi-storied building, so if the lessor has the right to change, boss, today you be in first floor. After 1 month, no, you don't be in first floor, you go to second floor. If this change is possible with very minimal disruption and very minimal additional cost to be incurred, then this means that there is a right which the lessor has to do a substitution. There are two conditions. They should have the practical ability, and you as a lessee will not be able to prevent him from doing the substitution. And the alternate place is readily available or can be available at a very short period of time. From your perspective, you feel that it would be economically beneficial. Again, this is a right which you need to choose at the time of inception of a contract. So let me give you an example on how a substitution right works. Say for example, you go to an airport, say Chennai airport, it has 4 floors. You want to set up a coffee vending machine. So coffee vending machine, say it requires say 500 square feet of area. So initially you say you got it in the ground floor, but suddenly after 1 month, if he wants you to shift it to the first floor, so giving a 500 square feet in the first floor, it's possible because he may have the area. Shifting it from ground floor to first floor may not be very significant. And you as a seller, we will also be comfortable that it is going to be equally advantageous to you setting it up in first floor as compared to the ground floor. So here, since the lessor has a substitution right, this particular contract, you may say it does not fall into the definition of the lease because you are getting only a space, you are not getting an asset. So this is the next concept that you need to be aware. See, what I'm doing here is I'm just trying to give you the various concepts of the standard. We spoke about the definition, we spoke about why this came up, we spoke about the exemptions, we spoke about substantive substitution, and before that we spoke about portfolio application. So what is the definition? It should be an identified asset. You should have the right to obtain substantially all economic benefits. You should be in a position to determine how you will be using the asset. The supplier or the lessor cannot dictate how you will use. You should be in a position to use the asset towards to the entire period of the lease. And the asset should be determined or designed in such a manner that you will be able to use the asset towards the entire period of the lease. So these are certain conditions that are given in the standard to determine whether the particular contract is coming under the definition of lease or not. So let us take an example. Say, for example, if I go back to the example of Shoppers Stop, 1 lakh square feet in, say, Express Avenue. So the contract can be two ways. So it can say, I give you 1 lakh square feet in the ground floor right-hand side as you enter the mall. Or it can just say, I will give you 1 lakh square feet and I have a substitution right. So there is a difference. In the first example, since it is specifically identified, you are getting the ground floor right-hand side 1 lakh square feet as the property which is given to you for you to carry out the business. In the second, so here is an asset which is determined. You will be able to identify it with your drawings, etc. So this contract will come into the agreement or definition of a lease. But if it is just saying 1 lakh square feet, it means that he can substitute it. But again, when I look at substitution, you will have to have the practical ability. We spoke about the reasons, but from a lease definition perspective, it may not fall into the definition. So the first important judgment call that you need to do when you come into 116 is to identify whether at all it is an asset or it is just a capacity that has been given to you. The second definition that you need to consider would be condition you need to consider is whether you will have the right to obtain substantially all the economic benefits from use of the asset throughout the period. See, I have seen agreements wherein it will say you pay a rent of X rupees per square feet, plus you also give me 1% of the turnover, what you make by using this premises. So if such a clause is there, the point that we need to discuss is whether you are not enjoying the substantial benefit because 1% of the turnover is going to the lessor. But how we need to look into it is different. See, you make the sales, you collect the proceeds from your customer. That is transaction 1. Ascertaining the consideration as 1% of the sale proceeds is a completely different financial agreement. So just because there is a financial agreement to share 1% of your sales as a rental does not mean that you don't get the substantial benefit or all the economic benefits by you using the property. So say, for example, the agreement may also say you also need to use this premises only till 11 p.m. So again, this will not be a deterrent for you in saying you are not able to enjoy the economic benefit. So this can be for safety purposes, this can be for providing the infrastructure. So that's completely different. So we need to be very careful in analyzing and understanding the contract before we conclude whether 116 is applicable or not. Okay. So the third condition is who is determining whether how the asset needs to be used. Sorry, I got some disturbance, sorry. So if you as a shop owner can decide what you have to stock, what you have to sell, at what rate you have to sell, at what discount you will offer, what brands you need to sell, then if you have all the rights, then you are satisfying this condition. Similarly, what purpose? So it's a departmental store, so you can use. So this is a very simple example on how you need to understand and review the contract to determine whether it is a lease as defined in the standard. Because if it is not a lease under 116 as per the conditions that I have listed down, then you will not be required to do the accounting under 116. So this is an example, as I spoke about the coffee vending machine. If you get into an agreement to hire trucks or say hire buses for transporting your employees, it will just say, I need X number of buses. I need it for 365 days except Sundays. I need it from this point to this point. Give him 25 routes. I will say this is the rate I use or I will pay for each of these routes. But whether he gives bus with registration number 1 or 100 or 200, it is up to the fleet owner to decide. He can substitute, but daily he need to ensure that he gives you 25 buses to do the transportation based on the route that you have given. So since there is a substitution right which is given, which is available with the fleet owner, it is not going to be covered under 116. So which means since the asset is not explicitly defined, you go under your normal accounting under AS-113 and you don't need to account this asset under right of use. So the next aspect we need to consider will be what is the lease term. So again, I think practically everybody would have seen the agreements where it may say, okay, I give it to you for 3 years. This is the rent. At the end of the 3 years, at the mutual convenience, we can extend it. If we can extend it for another 3 years, and you can extend it at 10% rental increase. You can extend it for one more 3 years, you give another 10%. So the contract provides for 3 plus 3 plus 3. So now, what is the lease period that we need to consider? So why is lease period important? When we discuss the manner in which you account, you will understand that the rate of use asset is being determined based on future lease rentals at a discounted value. So what is the period of future lease rentals I need to consider in this case? Should I consider it as 3 years, 6 years, 9 years? So that is the next important judgment call that you need to take. So again, you need to consider certain qualitative aspects in determining this rental, determining this. So if there is an option to extend, and if it is reasonably certain that you will exercise that option, or if there is an option to terminate, it is reasonably certain that that option to terminate will not be exercised. So I'm not confusing here. You just need to have a judgment call as to whether you will take the option to extend or whether you will not take the option to cancel. So this is a judgment call. So again, there could be certain factors that you may need to consider. Say, for example, you have a retail outlet. You have been on this place for 3 years. You have spent significantly on the interiors. To change premise will be costly, and sometimes it will also have an impact on the brand value. Say, you know that the customers know that you are in that particular street, particular address. So it has a brand value attached to it, and you will want to continue in that place for a long period of time. You would have done lots of interiors, lots of changes to suit your business. So if you have considered these intangible things, then you may come to a conclusion that there is a reasonable probability that the lease will get extended. So if you come to that conclusion that the lease will get extended, then you can consider the entire 3 plus 3 plus 3 to determine the lease term and then do the accounting under 116. So this is again another judgment call. So wherein there are conditions given in the standard, and there are also certain intangible aspects that you need to consider in determining the lease term. So this is an example. Say if you're developing a holiday resort, the proximity to the beaches, the probability of development, the cost of construction, the interiors that you have spent, the probable assumption that you take as to how the market rentals will change. So these are certain qualitative aspects that you consider before considering whether you need to consider the 25 years extension in determining the lease period or not. So one thing struck me at the beginning, I forgot to tell. So as you know, ICAI has come out with an education material on implementation of AS 116. So that education material has lots of FAQs. So if you have any doubts in implementing in standard, look at the education material and see whether your case is covered as an FAQ. See, many of my examples in the slide has been taken from the education material. This is an example which was taken from the education material on how you determine the lease term. Let us consider another example. See, you have been in a premises, you have been there for last 10 years. Every time you determine or enter into only a 11-month agreement. So after 11 months, you always had a case of having renewed it. So the question that is coming up is, since I have been in this premises and in the past I have always been renewing it, should I consider the renewal? Should I consider an assumption that again I will renew and consider it as a long term, or should I just consider it as a 11-month term and do a short-term exemption? The answer here is that you have a contract. It has been given to you only for 11 months. After this, the lessee does not have any right to extend. So though you had the past practice of lessor coming and offering you an extension for the next 11 months, you go based on the contractual period, which is here 11 months. So you can take the exemption of short term and take this particular contract outside the purview of 116, and you need not go with your past experience that it has always been renewed. Okay, next concept that I'm going to discuss is a particular agreement can have both lease as well as a non-lease component. Going back to my example of 1 lakh square feet. So there could be two agreements or one combined agreement which will say you pay rent of this much and you also pay a maintenance of this much. So if the contract specifically spells out what is towards rent and what is towards maintenance, it is well and good, because this standard should be applied only for the lease component. So you consider the agreement, whatever is relating to the lease, you apply 116, and whatever is considered to be towards maintenance, you go and account it as a period cost under your usual method. Because the standard is applicable only for lease agreements and not for maintenance. But sometimes it will be very difficult to segregate the consideration between lease component and non-lease component. Say, for example, it says you pay 15 rupees rent and we will take care of the maintenance. So out of this 15, what is the standalone price for rentals and what is the standalone price for maintenance? So again, this would involve certain assumptions. You go with comparatives or you go with past practice, etc., and judgment call comes into play. So you apply the judgment. If possible, you split this consideration of 15 into lease part and maintenance part. If you are not able to do it, well and good. The standard provides for a practical expedient. You can just give a disclosure stating that practically it was not possible for me to split the rentals into maintenance part and lease part. So I am accounting the entire amount under 116. So this is how you need to account for if a particular agreement has both lease component and non-lease component. Again, this is a judgment call which should get probably documented. See, again, there are two statements that I would like to make when we talk on Ind AS. One, judgments. Two, documentation. So like we saw under 113, there are lots of aspects which requires fair valuation. And the moment it comes to fair valuation, we all know that we have lots of judgment calls to make. Two, there are lots of assumptions that you are making in terms of this particular standard. The concepts that we have even covered till now, short term, low value, lease period, substitution, a lease period, discount rate, which I will talk about it, whether you are able to split between rental component and maintenance component. So these are critical judgments which the client has taken. And you as an auditor, if you are in audit field, or even you as a management, if you are in industry, need to have proper and adequate documentation and justification as to A, what you have done, and B, why you have done. The typical statement, people who have heard me, you will understand two things. One, what is not documented is not done. And two, with this environment where there are lots of reviews which are very rigorous, unless you have proper and adequate documentation, it will be very difficult for you to substantiate the calls, because the review can happen even after 4 years of the accounts closing. So at that particular point of time, the person who did it may or may not be with your firm. So unless it is adequately documented today, it will be very difficult for you to substantiate it to the reviewers. So that's why I generally in any seminar, my statement would be you have to exercise professional judgment, which is mandatory requirement of the standard, which should get adequately documented, because you cannot get caught on negligence of responsibilities. So as we go with the standard, understand what are all the critical aspects where we need to have a judgment, because all these judgment calls you need to take on the date of inception of the contract, because you take the judgment call on the date and then you do the accounting accordingly. So it is very important that you have a adequate documentation of these things. Accounting, very simple. You determine the period, you know the lease number, you know the amount you will pay, you take the future cash outflows, you discount it to the net present value, and whatever is the net present value that you got will be the value at which you account the right of use of asset. That is why I said the period is very important. And once you account the right of use of asset, you depreciate it over the lease period. Okay, what is important here is to understand what is the rate at which I will do the discounting. So what the standard says is, I will come to these slides in a short file. Let me understand how the discount needs to be done. The discounts needs to be done at a rate which is implicit in the lease contract. Because if, for example, the lessee has given you an asset for a lease, we need to understand what is the IRR of the lessee, which is very difficult. So what the standard says is that you consider the rate of your incremental cost of borrowings. Say, for example, if you need to create an asset, what will be the cost you need to incur? For incurring that cost, if you need to have a borrowings, what will be the rate at which you will be able to borrow? So this incremental cost of borrowings can be considered as the rate which is implicit in the contract or an agreement, and this rate can be used for discounting. So practically what I have seen is that generally most of the companies will take the incremental rate of borrowings for the purposes of doing this discounting. So how do we do this valuation? As I said, this standard became effective 1st April 2019. So whoever were already there in Ind AS on that particular day would have applied the standard in financial year 1920. For those people or clients who goes into Ind AS after this particular day, then you will be applying the standard in the year in which you do the Ind AS. Say, for example, I have a client whose net worth was more than 250 crores as of 31st March 2022. So Ind AS is applicable to them for financial year 22-23. So when I do the Ind AS for financial year 22-23, I will have to apply this standard of 116. So again, if I go to Ind AS 101 on how you transition to Ind AS, we all know that the first Ind AS balance sheet will have 3 balance sheets and 2 P&Ls. What are the 3 balance sheets in my example? 31-3-23, 31-3-22, and 1-4-21. Why 1-4-21? Since I am moving from IGAAP to Ind AS, any transition adjustments I should do on the net worth of the first period presented. And P&L of last year will get restated, and then I need to do the P&L of current year. And of course, the balance sheet and cash flow of last year also will get restated. So there could be certain contracts which gets covered under 116, which was available on 1-4-21 also. And there could be certain contracts which I entered into only after 1-4-21. So if I enter into after 1-4-21, it's straightforward. You apply the standard from the date of when you entered into the contract. If it is last year, you do the accounting for last year and then come to current year. But if you had a contract which is already available on 1-4-21, how do you account for it? The standard provides 3 methods. You can do fully retrospective, or you can do 2 approaches of modified retrospective. So what does it mean? So let us take an example. You had a 5-year agreement entered on 1-4-20, and you need to apply the standard on 1-4-21 because you apply the Ind AS for 22-23. So the comparatives will be 21-22, and all the transition adjustment should be done on 1-4-21. So what I can do under fully retrospective method is that on 1-4-21, you assume as if you have adopted Ind AS from day number 1 of entering into the contract. So if you have adopted the standard on 1-4-20, you will have a right of use asset and a right of use liability on 1-4-21. And you would have already taken some amount as P&L cost in the earlier years. And there would be a difference between the P&L cost already taken and the P&L cost that you need to take under 116 principles. So you make these computations and you account for the right of use asset, the right of use as liability, and the differential P&L impact, which would be an impact to the net worth on the 1421 balance sheet, and then accounted for 21-22, and then accounted for 22-23. So this is called fully retrospective method because you have entered into an agreement and did the accounting as if you had the entire accounting done under 116. See, mine is a theoretical example. It is just one case of lease. So you are able to go back and do the accounting. Consider my other examples of Shoppers Stop, 100 leases. It will be very challenging to go back the day, and it would have not been 1 year. It would have been even 6 years, 7 years. So the standard says you don't need to do fully retrospective. You can also do a prospective method, which means on 1421, you determine what is the future lease rentals payable. You know the agreement, you know the period, you know the discount rate. So discount this future lease rentals on 1421 and account for the right of use asset and the lease liability. Very simple. So you need not have any retrospective adjustment, you need not have any net worth adjustment. So you create the asset and liability on 1421, then account it under 14 last year and account it for current year. So that is called prospective method, which is suggested by the standard. So again, whether you are going for retrospective or prospective method is a choice which you need to choose. But again, the standard on day number 1, whenever you implement the standard, there are certain exemptions, there are certain, what should I say, guidance to simplify the method by which you use. So when we talk about the transition provisions, we will discuss about those exemptions which the standard provides when you are doing the accounting under 116 for the first time. Okay. There are certain aspects which you need to consider when you do the accounting under 116. It is just not discounting the future lease rentals at the net present value. One of the important aspects where you would have an adjustment would be on security deposit. So, see, we all know what is a security deposit. If you take a lease, you need to pay, say, 6 months rent or 10 months rent as security deposit. So there are 2-3 things which you need to consider. One, you need to see whether the security deposit is refundable or not refundable. 2, you need to see whether the security deposit earns interest or is it free of interest. So these factors would be very relevant. It would be there in the agreement, but you need to understand this for accounting this security deposit. Let me give you an example. Say, for example, it is a rent-free security deposit for 5 years. Say under old gap, and say the amount is 10 lakhs. Under old gap, it's straightforward. On the date you pay the deposit, you will debit security deposit and credit bank for 10 lakhs. Good. Now we are coming to 116. So determine the accounting under 116. You need to understand the concept of Ind AS. And one of the concepts of Ind AS is 2 of the concepts. 1, fair value, and 2, you need to understand and believe that nothing in this world comes free of cost. So what are you doing under security deposit? You give 10 lakhs today and you get 10 lakhs on surrender of the property back after 5 years. So the 10 lakhs amount per se does not change, but there is going to be a time value of money. The 10 lakhs time value of money today and the 10 lakhs time value of money after 5 years will be different. And when you do a fair value accounting, you need to account for this time value of money. And 2, nothing comes free of cost. So though this terminology is interest free, you need to assume that when you get back this 10 lakhs, it is substitute interest that you are getting. So how do I do the accounting? Step 1, since the money value differs, today I will account the security deposit at the net present value. Okay, if I'm going to receive 10 lakhs after 5 years, at the discount rate, what is the present value? See, the present value is 6 lakhs. So I account for the security deposit at 6 lakhs. So what happened? I paid 10 lakhs, but I need to account it at 6 lakhs. So which means there is a difference of 4 lakhs. So the journal entry is that I should reduce the asset value. So which means I should credit 4 lakhs for the asset. So where do I debit? The standard says that you need to debit your right of use. So which means the cost for entering into this lease is just not the discounted value of the future lease rentals, but it will also be a time value of money on the security deposit. So this 4 lakhs, which is the time value of money, is getting added to the right of use asset and it will get depreciated over the period of lease. Okay. So now coming back to the journal entry, you have this asset at 6 lakhs now, and you should receive 10 lakhs after 5 years. So the other statement, what did I make? I said nothing comes free of the cost. So I also need to do an accounting of a notional interest income. So what I do at every year at an assumed rate of interest, I debit this asset and credit this interest income. So if I do this interest income entry for 5 years, say 70,000, 60,000, 50,000 every year, at end of 5 years, the 6 lakhs will become 10 lakhs. And you get this 10 lakhs if you surrender the lease, put it in your pocket and go off. So this is very important for you. So the moment you see any interest-free security deposit, which is refundable, you need to do this accounting. One, discount it to account for the net present value, which will take the error of the time value of money, and do an incremental interest income, which is notional, so that the 6 lakhs become 10 lakhs because under Ind AS, nothing comes free of cost. If it is not refundable, it's straightforward because it will just be accounted as rental expense on a straight line basis over the period of lease. With interest, then there is no problems because it is straightforward again. You won't have any time value impact, so you will account for interest as and when you earn. Okay. So these are the 3 adjustments that you need to make when it comes to interest-free security deposit. We also spoke about the concept of straight lining of rent. So what does it mean under AS-113? You pay 100 rupees for first year, 110 for second year, and 120 for third year. So what do we do under straight lining? We take the total outflow divided by 36 and account the rental expenses every month. So there will be a difference between the rental expenses debited to P&L and the rental expense you pay cash. So this difference will be adjusted as deferred rent, which will be an asset or liability based on the direction. But at the end of 36 months, the cash flow and the P&L charge will be same. So if you see this kind of deferred rent in any of your balance sheet, when it moves to Ind AS 116, you will adjust this deferred rent towards opening retained earnings. So this is the next adjustment you should be aware of when we move from AS-19 to Ind AS. Only security deposit, the second is straight lining of rent. Okay. Leasehold land, say for example, if you take assets on land on leasehold, say for example, if you go to Irgata Court, you get into a 19-year lease. You would have paid lease rentals upfront. So what we did under Indian GAAP, we put it as a leasehold land under PPE, and we were depreciating it over a period of time. Here under Ind AS, this is nothing but a prepaid asset. So you need to move it out of PPE and put it as a prepaid asset, either a short term or a long term, depending on the period of amortization. Again, under Ind AS, I'm sure you will understand that the classification of the balance sheet happens as current and non-current, depending on the 12-month criteria generally. So if you have any leasehold land under your balance sheet for which you have done upfront payment, there could be a change in classification which need to make in the Ind AS balance sheet. So we spoke about substitution rights. We spoke about low value assets. So vehicle is one of the examples for substitution rights, and I have seen clients take Xerox machines or printers on lease. You pay to them a monthly fixed cost, or you pay them based on the number of copies. Generally, I have seen these assets getting covered under the short-term lease. Okay, so these are some specific accounting aspects that you need to consider. Yes, the question is whether there will be a depreciation concept on right-of-use asset. Yes, there will be a depreciation concept. That is what is going to be discussed in the next slide. So once you account for the right-of-use asset at a particular value, you need to depreciate it over the period of time. So now let us visualize how an Ind AS 116 balance sheet will appear. In the asset side, you will have the right-of-use asset, which will be at cost less accumulated depreciation and impairment, if any. You will have a lease liability on the liability side. And since the balance sheet is based on current and non-current, the lease liability will be appearing both as a current lease liability as well as a non-current lease liability, depending on the period of payment. You will have security deposit at a discounted value because, again, as I said, we recoup the security deposit balance over the time value of money. So this is from the balance sheet perspective. What will be there in the P&L? You will have the depreciation for the right-of-use asset. How do we close the liability? We all know how do we account for finance lease liabilities. So how do? We have set up a liability. You will charge interest, which will increase the liability, and the rentals that has been paid will be considered as a repayment of the liability. So you will have opening liability, you will have accretion of interest, and the rentals that you pay will be similar to the EMI, which will reduce the liability. So that's how the liability will become zero over the period of lease. So the next cost which hits your P&L will be the interest cost on the liability. Okay. The third item which will hit your P&L will be the notional interest income on the security deposit that I spoke about. So under 116 accounting, you will have, as I said, an expense of depreciation, an expense of interest cost, and an income of interest cost. So how is it different? See, when you look at the P&L presentation, you will have depreciation and finance cost and interest income. How did we do earlier? We just had rental expenses as part of your operating expenses. So that's why I said there could be a difference in EBITDA, there could be a difference in ratios, because what you account under 116 will hit different heads as compared to what you are accounting under 19 or in AS 17. How does it affect the cash flow? Operating costs, rental expenses, profit from operations impacts operating activities. Here, I will be accounting it as a loan repayment, which will be a financing activity. So there could be an impact in operating cash flow, and there could be an impact on the financial outflow. And as I said, all these adjustments, take it interest, take it as depreciation, take it as notional interest income, everything will get off for tax, and you will just claim the rental expenses paid as expenses. So that's why I said it is status quo for tax. And since there is a difference between the tax base and the book base, you will end up creating a deferred tax asset or a deferred tax liability. So this is just a comparison on how the balance sheet, P&L, cash flow, and deferred tax will appear under 17 as compared to 116. So this is the concept which we generally know. So lease can come with some incentives, it can come with future dismantling cost, it can come with some initial payout of commission, etc. So all those things needs to be factored when you determine the cost. So it is just not the net present value of the future lease rentals, but you also need to consider these costs when you account for the ROU asset. So this definition will be giving you an example: fixed payments, less lease incentives, variable payments, guaranteed residual value, purchase option, penalties. So these will be the fixed concepts which is there in the standard in terms of how do you account for the initial ROU. We know what is lease fixed payments. We know what is lease incentive. Variable payments, say for example, it may say your lease rentals will increase based on a cost inflation index. So we need to factor in not only the base payment, but also certain variable payments when it comes to account. We know what is purchase option. We know what is penalties for termination. What is expected guarantee? I will come back to it with an example. See, this is an example of index. See, not all variable considerations should get factored when you do the initial lease accounting. It has to be linked to some index like customer consumer price index, etc. Otherwise, if you just say, I need to pay 1% of my turnover, then that is not a kind of variable payment which needs to be factored in when you do the initial cost recognition. Guaranteed payment, it is a fixed cost. You need to incur that cost. So if that cost is determined at the inception of the lease, say for example, if I say I need to guarantee you a payment of 5 lakhs, but you need to know that you are going to end up getting only 2 lakhs when you sell the asset. So this 3 lakhs will be a sunk cost on day number 1. So this 3 lakhs should also get accounted on day number 1 when you do the ROU. So this is the slide which we spoke about in terms of the discount rate that we need to use. Interest rate implied on the lease is what the standard says, but it will be practically impossible for you to get it. So generally we use the incremental cost of borrowings. Subsequent measurement, I've already spoken about the asset which will get depreciated. There was a question in the chat which spoke about depreciation also. Yes, the ROU asset will get depreciated over the period of lease. And we know the liability accounting because this is very similar to a finance lease or an HPE accounting that we are used to do even under ICAI. So the next question that would be coming to me is, once I account, is it that's it, or will the value of the ROU asset and ROU liability change? There could be changes because the initial accounting was done based on certain assumptions. You assume the lease period, you assumed you will take the entire 9 years based on my example, but there could be some practical scenario wherein after 5 years, you will decide that you will terminate the lease. You had the option of purchase of asset, you may or may not exercise. The dismantling or decommissioning expense was an assumption. The index was something which you will know only as you go by. You can't predict the consumer price index, you will assume something, but as and when the index changes, the rentals that you pay would change. So the amount of asset and liability that you accounted on day number 1 needs to be evaluated for all the assumptions at each balance sheet date. So if there is a change in assumptions, then you need to recompute the asset value and the liability value, and the difference between the carrying value of the assets and liabilities and the recomputed value will go into your P&L. So the point of stressing here is that once accounted, it does not mean it is the same value lifelong. You need to revalidate that because of various assumptions that you had when you even did the initial accounting. So how do I present in the balance sheet? It can be presented in the balance sheet or it can be given as notes. The right of use of assets needs to be given. It can be presented separately or it can be included in other assets with separate disclosure. Liabilities, as I said, you will be presenting it as current and non-current. In P&L, you will be presenting the interest expense. You will be presenting the depreciation charge. Okay. In P&L, we also need to consider that there could still be a line item as rental expenses. So how does it come? If you have taken a short-term lease exemption or a low-value lease exemptions, then that cost will be continued to be accounted as rental expense as part of your other expenses. So again, we need to give disclosures in the financials as to what are all those assets for which you have taken a short-term exemption or a low-value exemption. We spoke about how the cash flow would get impacted. So the depreciation, the interest expense, the short-term leases, the interest rate, the subleasing income, the total cash outflow for leases, the additions that you made to ROU, the impairment charge that you took. So these would be certain disclosures that you will find in the balance sheet when you implement 116. Generally, people give it in tabular form, but there is no specific thing that it has to be on tabular form. Again, for any liability or commitment, you also give the maturity pattern because you also need to give how long that liability will be there, less than 1 year, 1 to 3 years, etc., etc. When you make the transition, as I said, there are lots of assumptions possible. The exemptions that you have taken, the period, the discount rate, the approach that you have taken. Again, those assumptions also needs to be disclosed in the balance sheet in the year of transition. So this is in quick summary of how 116 comes. So the main concepts that we discussed was the ROU asset, what goes into the cost of asset, the corresponding lease liability, how the asset is getting depreciated, how the liability is getting squared off, how do we do the discounting, how do we consider the discount rate to be used, what are the some exemptions that is available in terms of short term or low value lease. We also understood how we need to analyze the agreement to see at all whether there is a lease element or not. We spoke about substantive substitution rights. We spoke about portfolio applications. So, and we spoke about the disclosure aspects. So these are all very critical when it comes to a lessee perspective. But from a lessor perspective, I'm not going to spend so much of time because it's only another 6-7 minutes left. I can make one statement. It is either an operating lease or a finance lease, and there is not much of a change from a lessor perspective as compared to in the AS-113. So you know the conditions on when you classify a lease as a finance lease. You consider the economic benefit, the period, you consider the returns received, your 75% criteria, your 90% criteria. So again, you apply those conditions to see whether it's a finance lease or an operating lease. The point that we need to consider here is the classification of finance lease or operating lease is more important only from a lessor perspective. From a lessee perspective, irrespective of the classification of the lease, you end up accounting it in the same manner of right of use asset and the corresponding liability. But when a lessor perspective, there is a change. If it is an operating lease, you will show the asset as PPE. If it is finance lease, then you account something called the lease assets in the balance sheet. And this lease asset again, which is nothing but a gross investment in lease, which is again you will do the accounting, which is ulto of the lease liability accounting done by the lessee. Meaning you account for net investment in lease, you account for interest income, which will increase this net asset, and as and when you get your lease income, you will reduce the asset. So as I said at the beginning of the discussion, the lessor accounting and the lessee accounting gets mirrored with each other. Operating leases from a lessee perspective, lessor perspective, no difference. Capitalized asset, claim depreciation, and account for the rental income on into your P&L. Lessor disclosure, again, there are specific disclosures for finance lease and specific disclosures for operating lease. I'm not touching these things in much detail because not much of a difference as compared to in the AS-113. So I can just give you a minute, just run through the disclosures from a lessor perspective. Two concepts I will just touch upon very quickly: sale and leaseback and sublease. This is a good table given in the standard on sale and leaseback. We start with premise of 115. So what is 115 change as compared to the earlier accounting on sales? we move from risk and rewards model to control model. We have that 5-step conditions. We apply those 5 conditions or the 5-step model. And only when we conclude that the controls have moved to the buyer, we recognize sale. So you apply the same principle for a sale and lease transaction. From a seller perspective, only if you conclude that this is a true sale, which means the control on the assets have passed on to the buyer, then you de-recognize the asset, account it from a sale and lease back model, apply the ROU for the retained portion. For the portion where the rights have been transferred, recognize the asset or gain or loss. And the buyer will recognize the asset because he has taken control. But if you have concluded that it is not a sale and lease back in its strictest sense, which means the control has not passed to the buyer, then you cannot de-recognize the asset. So the asset will lie in your balance sheet, but you have received a consideration. So that consideration will be recognized as a liability in your books. And then you do the normal accounting of asset depreciation and liability settlement. So the crux point here is to understand and analyze the transaction to conclude that it is a true sale, either in full or in part. And for the part which is a true sale, as per 115, you apply the derecognition principle of accounting. And if it is not a true sale, you account it from a liability perspective. The last concept that I'm going to discuss is sublease. You might have taken some assets on lease. You would have given it on sublease. So how do we account for it? So this slides here would give you the principles on how to account for a sublease criteria. So you apply the standard of 116 for your main lease, which is the lease which you have taken. And then the next transaction is that you have given that lease as a sublease. So if the head lease is a short-term lease and short-term exemption is there, then the sublease should always be classified as only an operating lease. But again, this transaction needs to be analyzed on the date of application. Whether it's a finance lease or an operating lease of a sublease, or you as an intermediate lessor, will be with reference to the main lease. So there are 3 points. Classify it based on the main lease. See whether you have taken a short-term exemption or not. And these factors will determine how you classify the sublease. So, and once you know the classification, you will know the accounting to be done. So these are certain conditions in terms of how you account for and how you disclose a sublease transaction based on whether you classify the sublease as an operating lease or a finance lease. Again, this stand of whether the sublease is operating or financial is a judgment call, which needs to be done on the date you get into the transaction and at the time of inception of the contract. So these are some couple of concepts which the standard has with reference to sale and lease back and the sublease. So the last aspect of today's discussion is on transition provisions. If you are moving from 17 to 116 or AS-19 to 116, one, you don't go and revisit lease definition. Meaning, if it is a lease under 19 or 17, it is a lease under 116. If it is not a lease under 19 or AS-17, it is not a lease. So you don't need to go and revisit the standard. If there are practical expedients used, you need to disclose. Short-term exemption, disclose. Interest rate, what it says is that for all the leases taken together, you can choose one interest rate rather than applying different interest rates for different agreements. If the remaining period of the lease on the day you apply 116 is less than 12 months, you can still apply the transition provision. See, what I have told initially was that you need to see the period on the date of entering into the lease. It is for ongoing lease. But what the transition provision says is that if your remaining period of the lease is less than 12 months on the date of transition, you straight away apply the transition provision and you don't need to get into 116. So I spoke about 116, we spoke about next 12 months. We can exclude the indirect cost from measurement. You can use hindsight for determining the period. Say, if I go with the example of T plus 3 plus 3, and if I know that at the end of year 5, I have given the termination notice, this hindsight benefit is available to you, and you can use this hindsight in determining the period. There is no requirement to do it for 9 years and then account for a modification on the date you gave the termination agreement. So that's on 116. So what we covered under 116 was to understand what is the lease definition, certain concepts like substitution rights or a portfolio application, certain exemptions to the standard like short-term leases and low-value items, certain assumptions like lease period, lease modification, discount rate. We understood the disclosures. We slightly touched upon the lessor accounting and did not go much in detail because there is no significant difference in accounting between 19 and 116 or 17 and 116 when it comes to lessor. And we spoke about certain major assumptions when it comes to transitioning from the old standard to 116. And we also looked at certain specific examples like interest-free security deposit or non-refundable security deposit or leasehold land, etc., and how the accounting or disclosure would differ when it comes to 116 as compared to the old standard. And importantly, we also understood how the P&L balance sheet and cash flow will appear under 116 as compared to the old standard. So I'm sure that you would have found this both the sessions, 113 and 116 useful to you. This is my credentials. Please feel free to message me or mail me in case if you need any further clarifications or any discussion points. I'll be more than happy to clarify it offline. So that's it from me. I'll just wait for a couple of minutes to see whether people have any questions. If there are no questions, thanks a lot for your very patient hearing and enjoy your evening. I'll just wait for a minute, and if I don't see any further questions, we'll be signing off. And participants, thanks a lot. And SIRC, thanks a lot for the opportunity.
Yeah, thank you so much, sir.
I'll just wait for a minute, and if I don't see any questions populating, I will sign off.
Sure, sir. Okay, thanks a lot. Enjoy your evening. See you. Bye. Thank you so much, sir. You too.